So this screencast is just a quick overview of the tools of monetary policy if you need more support about those three tools. So first of all, the Federal Reserve uses monetary policy to influence the amount of money in the money supply. So there are three tools of monetary policy. There are the open market operations, reserve requirements, and interest rates. And there are three types of interest rates. There's the discount rate, the federal funds rate, and the prime lending rate. So I actually would suggest that you pause the video in a moment and make a chart like this. Okay, so hopefully you paused and you drew this graphic organizer, but how we talk about these three tools of monetary policy, we generally talk about them in the context of what are we doing with them to expand the economy with expansionary policy here, and then what are we doing to contract the economy? So, open market operations is just a fancy way of saying the Fed is either buying or selling bonds. And don't forget that bonds are sometimes also called securities. So, there's a lot of vocabulary here. Open market operations, the Federal Open Market Committee on the Federal Reserve is the group that determines whether or not this is going to be done. And also, we call this the bond market. So, these are bonds that are United States Treasury bonds. When you think about a bank having bonds in their vault, somebody can't go to a bank, ask for a car loan, and the bank can't tell them, here's a bond, go bring that to Toyota. The person that's getting the loan needs to actually have cash. So the Fed can determine or decide, I should say, to buy or sell bonds depending on how much cash they want banks to have available for loaning. So, if the economy needs to have more money circulating out there in order to expand it, then the Fed is going to do things to help banks have more liquidity. They're not giving banks free money. It's like the substitution effect. So, banks have bonds, and these bonds are either sitting in their vault or they're at the Federal Reserve, but it's the bank's money. But what the Fed can do is say, hey, bank, we're going to buy those bonds from you. So by doing that, now the Fed brings money. They have money sitting in the vault now instead of the bonds. On the opposite, if they wanted to contract the economy, they want there to be less money out there for loaning. So they're going to sell a bond to a bank. Now the bank has a bond sitting in it that they can't loan out, and the money is under lock and key at the Fed. So it's just a swap. It's not like it's free money being given to the bank, it's just a swap for value. The reserve requirement we've done a good amount with already because we've done bank balance sheets, but the reserve requirement is how much money is sitting in the vault. So that cannot be loaned out. So typically it's somewhere between 10 and 20% in the United States. And those are usually the two numbers that you're going to see in our course. So if the Fed wants there to be more money available for loaning, they're going to lower that reserve requirement. So let's just use easy numbers. If you have, let's say, $10,000 in a bank and they're supposed to keep 10%, $1,000 in their vault, if the Fed wanted to expand the economy, they could lower it to 5%. Now they have more money available to loan out. Whereas if they wanted the banks to have less money, they would just increase that reserve requirement. And that's going to change the money multiplier as well. So if you think about it, if you keep 10% in a vault versus 20%, the money multiplier with a 10% reserve ratio is 10. And the money multiplier with a 20% reserve ratio is 5. So if you have a 20% reserve ratio, you're going to have less of a multiplier impact on the money supply. So that would be contractionary to increase the reserve requirement. Interest rates are another way that they can either control the money supply through expanding it or contracting it. Think of interest as the cost of borrowing money, and interest can impact you from another perspective as well in terms of investing. Like we can earn interest off of savings, but we also pay interest upon borrowing. So if interest rates are low, that means it costs very little to borrow money. So therefore, people are going to borrow more. That's meant to expand the economy when interest rates are low. When interest rates get increased, this is going to contract the economy because now it's going to become much more expensive to borrow money, and therefore people are going to borrow less. You need to know what the three interest rates are, and it's very, very likely that you could be asked to just define what these are. The discount rate is the rate that the Federal Reserve charges banks for loans. So banks can borrow money if they don't have enough to cover their reserves for people who want to withdraw money, but then they have to fill that up with money they've borrowed. So banks are often not only paying back loans that they've incurred, but they're also taking payments from people who have borrowed from them. The discount rate is the rate that the Fed charges banks. Yes, it is the lowest interest rate, but we don't want to borrow from the Fed all the time because the Fed is going to sort of scratch their head and say, why are you loaning out so much money that you have to borrow repeatedly, Mr. Bank? So banks sometimes will borrow from their friends rather than their strict parents. So they're going to borrow from other banks. And the Federal Reserve has an interest rate that banks must charge each other called the federal funds rate. Sometimes you'll see it in a newspaper article or an online news article called the overnight lending rate. And that's really just Webster Bank can't meet their reserves, so they call Bank of America across the street and say, can we borrow $4,000 from you? And they can either electronically transfer it or bring it in an armored truck. And I'm sure you guys have seen those around. Why would the Fed set this rate? Because if banks were able to charge each other whatever they wanted, they could conceivably drive each other out of business and have monopoly power. So, because the United States discourages monopoly power, by having the government control this, it has much more regulatory power over the economy. The last thing is the prime lending rate. That's the interest rate that you and I would pay if we were to take out a loan for like a car or a house or for college or any other sort of big spending project. Like we wanted to put a new roof on the house and we wanted to borrow money from a bank to do that. So that's called the prime lending rate. So again, we need to know how these things would expand or contract. So just to reiterate, to expand the economy with open market operations, we would buy bonds. This is going to make the money supply bigger. We would decrease the reserve requirement because that would give banks more money to loan out, less to keep in their vault, and we would decrease loans, their cost of them. We would decrease the interest rates rather, because that would make borrowing money less expensive. People are going to do more of it. To contract the economy, we would sell bonds to banks. It's always the Fed doing the buying or the selling, okay? So if we sell bonds to the bank, they're going to have a bond in their vault instead of cash. Therefore, the money supply will become smaller. We would increase the reserve requirement. So again, they would have less money to loan out and more money in their required reserves. We would also increase interest rates so that way it would cost people more money to borrow. The prime interest rate is higher than the federal funds rate, and the discount rate isn't even shown on this graph. But this is a really interesting graph showing from 1998 to 2013. And you'll notice that 2009 is when we started to hit a recession, and the interest rates are falling from early 2008 basically into 2009. The financial crisis happened in September of 2008, and it isn't until about 4 to 6 months later where we start to truly see the consequences in terms of unemployment and interest rates. But every time you see the interest rates start to climb, that coincides with the time in the United States where aggregate demand was up, the money supply was growing, people were spending more money, and we were experiencing inflation. When you start to see the interest rates fall, it means that people were spending less money, businesses weren't investing as much, people weren't borrowing as much, and we perhaps started to see prices fall. Now, prices falling is okay for the short term, but if we have rapid deflation, it's almost like we could pull all of the air out of the balloon at once, and then there's no balloon anymore. It's just deflated completely, and the economy's gone. So we don't want things to bottom out. This is a little graph of the federal funds rate from the 1950s to today, basically. It's a couple years old. It doesn't really have anything since 2014. But you can see the general trend over the last 60 years in terms of interest rates that there really is no quote normal interest rate. It really is dependent on what's happening in the economy. But by looking at an interest rate graph like this, it almost looks like an EKG that somebody would be having to measure their heart rhythms. It goes up and down, and sometimes there's plateaus and sometimes there's small little blips in interest rates, but for the most part, you can see that there are some really, really drastic differences between peaks and valleys. And in the early 1980s, we had tremendous inflation in the United States, and banks were charging each other interest around 19%. That means that people like you and me were probably, if you go back to this graph, look how much higher the prime interest rate is. People like me and you were probably being charged over 20% to borrow money. And that's huge. If you borrow $300,000 to buy a house, that's a lot of money to pay just in interest on top of what you've borrowed.